Advanced Financial Modeling, Topic 23, International Corporate Finance, Section 4. We're going to hedge FX transaction losses. So suppose Ingersoll Rand enters into a contract to buy 100,000 euros in equipment from a German firm when the exchange rate is $1.10 per euro. Delivery is 1 year from now. So 1 year from now, they're going to take delivery of the equipment and send 100,000 euros. When Ingersoll Rand goes to pay the invoice next year, the exchange rate turns out to be $1.30. So the euro is appreciated. How much more did Ingersoll Rand pay? Well, they're expecting to pay $110,000 to buy the 100,000 euros to get the equipment. However, the exchange rate turned out to be $1.30, so they paid $130,000 for 100,000 euros for the equipment. So they spent an extra $20,000. Now, there's a general formula for this transaction loss. Now, I'm going to define a transaction loss as a loss in cash flow due to a change in an exchange rate. So it could also be a gain, right? If the exchange rate fell, that could be a gain. But the general formula is going to be the value of the foreign currency, say 100,000 euros, times the new minus old exchange rate. And by the way, these always have to be in direct terms. So even if they're an indirect quote, you have to flip them. So also, this V, this foreign exchange, if you are receiving it, represent that as a receivable, say, put that as a positive number. If you are paying that value, put it as a negative. So I'm going to say negative V, 100,000 euros, times the change in the exchange rate, S1 minus S1 minus S0 is a $20,000 loss. Now, how could Ingersoll Rand hedge this position? Well, they could have something we call a cash hedge. They could have just put 100,000 euros in a bank today in Germany, earn some interest, and wait until the bill's due. That's one way to do it. Actually, even more genius is they can just, if they say the interest rate is about 1% in Germany, they could just put, say, 99,000 euros in an account. That'll be worth about $100,000 next year, and when the bill is due, they'll just deliver it and get their machine. They can also use a forward hedge. They can enter into a forward contract to buy 100,000 euros at the forward price. Option 3 is they could buy a call option to purchase 100,000 euros at a strike price on the expected payment date 1 year from now. However, in this case, they must pay a premium. Let's talk a little bit about the Black-Scholes formula. Here's the function. It's in the spreadsheet. If you want to value a call or a put on a currency, this model is made for stocks, but we're going to use it for currencies. So we're going to put in the current spot price of the currency. Say the euro is selling for $1.10. You want an option to buy or sell the currency at, say, $1.05. V is the expected standard deviation of the changes in the exchange rate over the life of the option. This option is the 1 year option. I'll put in 1. Where R is, I'm going to put the US risk-free rate for that maturity. And for dividend yield, D. Now for stocks, I would just put the dividend yield in, but for currencies, I'm going to put the foreign interest rate. Now here's the intuition. If I own a stock, I get the dividend. If I owned a currency, I deposit in a foreign bank and I earn that foreign interest. So when I plug this information in, it looks like the call is going to cost me 7 cents per every euro on the option contract, and the put will cost me 3 cents per euro. And let's take a look at a call and put on the Chinese yuan. I'm going to go to the spreadsheet, and say the current spot price of the yuan is 7.15 yuan per dollar. For Black-Scholes to work, everything has to be in dollars. So I'm going to take 1 over 7 yuan, and what it really is 14 cents per yuan. And let's just pretend we're going to do an at the money call and put on the yuan. So I'll put 7.15 in again, and I'll put the expected standard deviation of the exchange rate, US 1 year interest rate, 1 year option, and I'll put in the foreign interest rate. So that'd be the Chinese interest rate. And that tells me for every call, for the call on every yuan, it's going to cost me about 0.6 cents and 0.7 cents for each put. So that's how you value a call or a put on a foreign currency in direct or indirect terms. Now let's do a little example. I made up an example called Multinet Corp, MNC. Real simple model. They produce products in China, paying CNY, sell its products to Europe, earning EUR, that's Euro and Chinese Yuan, and they manage from a headquarters in the US, paying some USD. So what's their expected profit? Let's go to the spreadsheet. I'm going to look at MNC, and what you see is a pretty simple business model. Let's say the expected exchange rate 1 year from now is $1.10 for the euro and 6 yuan. That's the expected exchange rate. That's also the forward exchange rate. Remember, according to unbiased forward rates, UFR, expected spot rates are forward rates. And say, here's their business model. They're going to sell their widgets for 105,000 euros. It's going to cost them 350,000 yuan 1 year from now. And they're going to pay $45,000 in G&A, general and administrative expense, in dollars. And if the exchange rate turns out to be 110 and 6, that revenue is worth 115,000. The cost is 58,000 to produce the widgets, and they're going to make 12,000 in operating profit. Now, what's interesting is down here, if I look at what happens, I did a data table. I looked at what happens to this number here as these two exchange rates change. And what you see, their exposure is to a appreciating yuan. So when the yuan goes from 6 to 5 to 5, that's a devaluation of the dollar, appreciation of the yuan. And their exposure is to a devaluing euro. So it makes sense. If the yuan is getting more expensive and they're buying that labor, it's going to cost them more. However, if their euro revenues of 105,000 are going to be worth less and less dollars if this exchange rate falls. So their biggest exposure is this grid, this area of the grid right here, which is a devaluation of the yuan. It's an indirect quote. That's why the number's going down. And an appreciation of the yuan. That's an appreciation of the yuan, because it's an indirect quote, and a devaluation of the euro. So let's look a little bit farther. Say they want to hedge their position, and what they're going to do is they're going to enter into a forward contract to buy 350,000 yuan and enter into a forward contract to sell 105,000 euro at these two prices, 110 and 6. So when I put that into my spreadsheet, if I go to forward hedge, I already put it in there for you. If you have a contract to buy yuan, the formula is going to be whatever the spot price is minus the forward price times the quantity. So that's going to be, and also I have to put all these in direct quotes to get a dollar price. So the expected spot price is 1/6. The forward price is 1/6. But that's going to be negotiated, so I don't have that cell reference there. And this is 350,000 yuan. And then, and there's no payoff now, because right now I'm assuming the expected exchange rate and the forward exchange rate are the same. Next, the payoff for the seller, the contract to sell euros, is going to be the F forward price minus whatever the spot price turns out to be next year, which is the reference of this cell that allows me to change it, times 105,000 euros. Notice when I put those formulas in, there's no payoff immediately, but what you notice, if the exchange rate were to go down to say, well, let's look at this number here, 12,167. If I were to change the exchange rate to 0.9, notice it's still 12,167, because that loss in revenue, the reduction in this number, is perfectly offset by this number. I'm going to hit undo. And what if the exchange rate were to go, the yuan exchange rate goes from 6 to 5? That's an appreciation of the yuan. Notice these costs went up, but perfectly offset by the gain in the Chinese yuan forward. And I'm going to undo that. Notice when I do my data table, I'm no longer exposed to currency revaluations. And there's one other thing they can do. They can enter into an option contract. So what if they enter into an option, a call option to buy 350,000 yuan and a put option to sell 105,000 euros. We're going to set these at the money options. So we're going to use let's use these expected spot prices right here. So that's actually called a forward at the money. So I'm going to set the exchange rate equal to the forward prices. And then I'm going to put in my cost of my options. I'm going to buy a call. That call buy a call on the yuan. I'm sorry, on the Chinese currency. That's going to cost me 17 cents. And I'm going to buy. It's going to cost me this amount. Let's go to the spreadsheet and look at this. Here's my option hedge. I'm going to enter into a contract. Let's look at the prices I have here. This is my currency price per FX unit. Here's my strike. So I'm looking at a put option to sell 105,000 at 110, and I put in there. Here's my contract to sell. Buy 350,000 yuan at 1/6. And let's just say that the price of those options, I'm not going to use Black Scholes. Let's say the price of those options are 5 cents per put and 1 cent per call. Just for simplicity, I just didn't want a lot of decimal places here. So these are actually the premiums for the options. So let's go ahead and put our formula in for the payoff of a call and put. So remember, we have a call on the Chinese yuan. The first thing I did is I put in the cost of the option. 350,000 times 1 penny. And then here's the payoff of a call option. Max 0, spot price, minus the strike price of 6, inverting both of them, times $350,000. So what this represents right now is just the cost of the option. And here's the cost of the put, 105,000 times 5 cents per put. And here's the max of 0, strike price minus spot price times 105,000. So here's what happens now. Notice my exposure is different. The worst case scenario is if the Chinese yuan appreciates. My worst case profit is 34.17. It doesn't get any worse. Notice now this is worse than it was before because I paid those premiums. However, it doesn't get any worse. I can't go bankrupt anymore. Either if the yuan appreciates or if the euro devalues. However, if they still retain upside, because since these are options, they'd love it if the euro appreciates and they get more revenue, and they'd love it if the yuan would devalue and they pay less for their production. So this gives them a different payoff where you're going to reduce your expected cash flows today because you pay the premium, but then you don't worry about the exchange rate going against you, but you still wait for hope the exchange rate goes with you in this case. So in this example, we looked at how to hedge FX transaction losses using forwards and options.